Welcome to Financial Revelations. I am David Safransky, your host. And I want you to remember that present actions create your future results. And that's what we're going to talk about today is what can we do here presently today to cause some great future reactions. And it's a Fed meeting day. Fed's going to have a press conference at 2:30. And we're going to talk about that and what they're doing today that is potentially going to cause either great things to happen or they're going to reset the market for us. But before we get to that, I want you to remember that you can email questions to Joshua at epsf.com, and it's going to be right up here, Joshua at epsf.com. And I want you to follow us on Twitter at Fi Revelations, Fi Revelations at Twitter. Because what we're going to do is we're going to gather some data there from people who are following us. And we're going to throw out some surveys out there. I want to see what people are thinking. I want to see how we respond. And I'd like to go over some of that data on future podcasts. So if you wouldn't mind following us on Fi Revelations on Twitter, that would be great. And look for a few surveys coming out. They usually last a couple of days up there, so you'll have time to formulate your answer. It's really just a multiple choice. In college, we called that multiple guess, but it is multiple choice. So I'll give you some different things about debt, investing, just what people are thinking. And I really want to know what people are thinking because the market is changing. It is a Fed meeting day today. They met yesterday and today, and they'll have a press conference. Chair Powell will have a press conference today where he'll be, he likes to talk extemporaneously a lot. And so he'll take 30, 40 questions probably. Mind you, when Alan Greenspan was chairman of the Fed, he would take questions too. It's just you never knew what he was saying. I don't know that he knew what he was saying. He tried to be as evasive as possible, as cryptic as possible, as nebulous as possible. And we used to get a little bit frustrated by that and say, well, gosh, I just wish we knew what the Fed chairperson was thinking. And then we got Jerome Powell, Chair Powell, and we knew what he was saying, and we don't like that. It turns out we like it a lot more when Alan Greenspan would say something. I have no idea what he just said, but it sounded good. The language was flowery. The market really likes that a lot better. They don't like when they know what the Fed chairman is thinking or the chairwoman. We have had Janet Yellen. She's now the Treasury Secretary out there selling very hard Joe Biden's budget. I don't think any of that's going to get passed in the way that they think it is, but we'll see. So at the Fed meeting today, I think there's a couple things that could happen. If they use any of the following terms, so any of these terms are used in the press conference, in their prepared statement, or afterwards in the extemporaneous questions. If they say the word taper, there's going to be a sharp reaction. If they use the word combination rate adjustment, there's going to be a sharp reaction. If they use the word, now I know they're not going to do this. If they were to use the word combination rate hike, I think any three of those word combinations being used is going to lead to a 5 to 10% market correction over the next couple of weeks. And it would be totally appropriate to have that happen. And the reason for that is it would represent a change of direction for the Federal Reserve. Now, they may say we're looking at the calendar. They may say things like that, but if they use those word combinations, even if it's in the questions from reporters, and what you'll notice is Chair Powell kind of gets frustrated after a while because he's going to get the same question 10 straight times. Just somebody hoping that he's going to use that word combination and create a little bit of news. If that happens, and there is a 5 to 10% market correction, which again would be totally appropriate because of the change in direction, it would be it must be the best investable moment since February of 2020. Any time that there's a change in direction in the Fed, they like to, Chair Powell likes to look to the future a little bit. And really, the Fed should be data dependent and long-term data dependent, not just short-term data dependent, but long-term data dependent. That being said, there probably is no real reason to raise rates at this moment. Now, I understand that inflation is running much hotter than normal. It's way hotter than normal. I do believe that the Fed is correct about this, that some, if not most, of this inflationary pressure that we're feeling right now is temporary. Think about last February. We shut down. You could not go to work. You could not build a house. You could not drill an oil well. You couldn't cut down a tree for lumber. You couldn't do any of those things. We halted trade, cross-border trade with Canada. Now, it did seriously affect our supply of hockey pucks and bad bacon, but we shut down trade, especially with Canada. Right there, our marketing representative, Joshua, was telling me how many people lived in Canada, how many people lived within an hour of the border. It's the vast majority of the people in Canada live within 1 hour of the U.S. border. They rely on us dramatically for trade. It's the easiest trade that they do. It's the closest trade that they do, and it's probably the most profitable trade that they do. So we totally stopped that. And just COVID in general, the slowdowns that occurred, even in states that remained fairly open, these things everything just stopped for a long time. So I do think in a lot of ways those inflationary pressures that we're having right now are mostly temporary. Now, temporary could mean through the end of this year, but when you're thinking long-term, 3, 5, 10 years, that would be temporary. Now, some are not temporary. I think the biggest inflationary pressure that we're feeling right now that is not temporary and may be here to stay for a while would be fuel prices. A federal judge yesterday did rule that the Biden administration's ceasing of new leases and terminating leases for oil and gas drilling on federal lands they can't do that. So that's been halted. So that could bring a little bit of the pressure down. But as oil prices are rising, I think we're just looking at gas prices around here in Avon, Ohio, about $2.67 for regular gas. And is that what we said? $2.60
at Costco.
At Costco. Okay, so it's a little bit lower. Sam's Club. I live in the lovely boating community of Vermilion, Ohio. We never get gas there. And unless you're about to run out of gas, you do not fill up in Vermilion because gas prices are usually at least 25 cents higher there. So normal gas prices, $2.67, $2.75. If you're out in California, it's probably $7 a gallon. But I think that those prices are here to stay for a while, and they're going to go higher, which is always perplexing to me because what it does is it really does provide energy, fuel, money, everything for countries that we don't like, and they don't like us. A lot of the countries in the Middle East thrive off of these increased oil prices. Russia is really not that big of a threat to us militarily and economically. Economically, they're no threat to us. But what the rise in oil prices does for a mainly commodity-based economy like Russia is it brings them back into the fold. We don't really want to do that. So keeping oil prices low, allowing us to drill and provide resources for the world really puts us in a huge position of strength. And by allowing oil prices to creep up like they are, it kind of hamstrings the United States in a lot of ways. And it makes us reliant on other countries that don't like us and use our money to fight against us. So I think that the Fed is going to probably talk about those things today a little bit. And they're going to, they love this, they're temporary inflation increases, but they call them transitory. They have to come up with a nice phrase for it. They're transitory as we transition away from COVID lockdowns back into a normal economy. And that is going to happen. That's going to happen through the rest of this year. Even California is coming out of lockdown now. So the sun is shining across this nation again. But here's what the Fed should be saying today at their press conference. They should be saying things like inflation is expected to moderate significantly this year. Lumber prices, and I'll give you an example, lumber prices are already about 40% off their highs. Now they're still 200% off their normal, but they're coming down. You're starting to see people who hoarded lumber are now dumping it into the market because they don't want to miss the fall, or they don't want to be there for the fall and be owning all this lumber as prices start to moderate. So you're starting to see the market get flooded in lumber a little bit. I'm shocked at what a 2x4 costs right now. If you have bought anything from one of these big box home stores like a Lowe's or Menards or Home Depot, the price of stuff is shocking. I just did a little project in my backyard at the Vast Safransky estate, and unbelievable. It was 35-40% more than what it should have been. So I think the Fed is going to talk about inflation moderating over the course of this year, and employment increases will dramatically increase the productivity levels in America. And one of the things that is causing inflation is the fact that we're paying a lot of people to sit home right now. So there's a lot of money flooding into the system at a decreased productivity level. So if you increase productivity, people are making more goods and services while you're increasing the money supply, inflation should remain at bay or even fall. But because so many people are staying home right now, collecting the COVID kicker, which is ending in a lot of places at the end of June, I think you're going to see employment numbers dramatically start to increase over the course of the summer. Out in my backyard is Cedar Point. It's a huge theme park. Many of you probably know about it, but they can't get workers. They can't get people to. A lot of the countries still have travel restrictions to the United States. They employ about 20,000 foreign workers. Is it 20,000? I think it's 20,000 foreign workers a year. They couldn't get them, so they've had to moderate rides, and early on their schedule was a little bit moderated where they weren't open every day. They just couldn't get workers here. And so as you see hiring increase, I think you're going to see some of that inflationary pressure start to moderate. And the other thing that they should be saying is we really are on the road to recovery in a very real way. The market the economy is starting to open up and heal, and people are going to start buying. And in the bank right now, at this very moment, there's about $2.5 trillion more than what is normally held in savings accounts. As people are allowed to travel, and people are traveling and they're buying and doing things, that money's going to get spent. That's going to drive the economy. And we are going to get an infrastructure bill of some kind. I don't think it's going to be $2 trillion. It could be. I don't think it's going to be that. But infrastructure is one of those things where it makes sense to spend money on infrastructure because it creates long-term jobs, not just the jobs building the roads and stringing the internet and things like that, but it pays dividends in the long run. It pays you back. So you invest in roads and bridges and infrastructure, information like the internet, where you're going to pipe it into the poor areas of the country, and that really disperses information equally. It allows people to go to college from home, as we have seen is now possible. That will be a good thing. That will pay dividends back, and you will make money off of that in the long run. And the last thing that I think the Fed should really be saying today is that they are long-term data dependent. And what happens is the market tends to be very myopic in what's happening today, what's happening this month, what's happening this quarter. When you live in the investment world and you're looking at companies and you're reading research, you're really reading to the next quarter. So that's 3 months that the market pays attention to. And in general, it could be a much shorter period of time than that. The market is not long-term focused at all, but the Fed has to be. And so the way the Fed could bridge the gap between higher inflation now and moderating inflation later, probably towards the end of this year, is to talk about how they're long-term data dependent, that they're plotting these numbers over the course of 24 and 36 months, not 24 or 36 days. And I think that will give the market a little bit of breathing room to say, okay, it's going to be all right. We're not going to see, housing prices are not going to continue this way. And they're not. Now, one of the things I think is going to happen is that if you bought a house in the last 3, 4, 5 months, or you're going to buy a house in the next 3 or 4 months, you're going to be locked into this house for a number of years, because I think as prices moderate, so they're going up, they're going to level, I think you're going to see a little bit of comeback on these prices, so a little bit of depreciation. So it's going to take a little while longer for you to be able to make money on that house, but I think that's coming also. So the people that are buying right now in this window of about 3 months prior to this and 3 months in front of this, you're going to be there for a while. But that's okay. That's where you live. That's your house. It's in general, people don't flip houses like they do used cars. So I don't really have a problem with that, but I need you to be prepared for that. That's what the Fed should be saying today. I do think that if Chair Powell makes a mistake today, you're going to see a 5% correction in the market. I want to be ready to invest in that. As a firm, we have probably a little bit more cash than normal on hand right now, just for that. And remember, we want to invest in the greatest companies on the worst possible news, because we think long term, not 3 months from now, not 30 days, and not even really this year. I'm thinking 5 years down the road, because that's when you're going to want this money back. So if you're going to be an investor, and I know that there's a lot of these meme stocks out there like Bed Bath & Beyond and AMC, and there's a couple of new ones today. And yeah, people are making money off of those. We don't need to take that kind of risk, and neither do you. You can make money in the market, investing, planning, being wise. You could make a lot of money in the market over time. Now, it doesn't mean that there's guarantees. There's no guarantees in the market. But if you invest, you got to be willing to take the time, and you got to be able to buy in when everybody's running away. So you're running towards it. Everybody's running away. It's the fireman theory. The building's on fire. What does a fireman do? They run into the building. It's totally antithetical to what most people would do. But investing in the same theory is like that. When everybody is saying, oh, you got to get out, you got to get out, you got to put money to work. Financial Revelations, you can follow us at Fi Revelations on Twitter. I want you to follow us there. You can email joshua@epsf.com. Any questions that you have, concerns, comments, anything like that. We want to hear from you. We look forward to hearing from you. I am David Safransky. This is Financial Revelations, and I'll see you next week.